Hello and welcome to the first edition of our video series for 2021. As you know, I try to do these every few weeks, depending upon what's going on. Ordinarily, you'll get a video if things are a little bit weird or if markets are a little bit more topsy-turvy than what they have been. Sometimes when things are a little bit more quiet, the time between these videos might be a little bit longer. At any rate, Happy New Year to everyone. I hope that your Christmas and New Year celebrations were wonderful, peaceful, blessed, all that good stuff. And so now we find ourselves into 2021, and we're past the election stuff. We're coming up into inauguration stuff. We're all sorts of narratives are playing out in across the news cycle and, of course, amongst people's minds. My point with regards to managing money is that if you hear someone have a conversation on TV, radio, or newspaper or anywhere, if anyone's talking about anything that has anything to do with any market, currencies, rates, equities, bonds, commodities, doesn't matter. If anyone's having a conversation that does not start mathematically or include lots and lots of numbers as that conversation progresses, it's a narrative. And you need to ignore narratives when it comes to investing in markets. And it doesn't matter which market it is. If it is a story, it's a narrative. Wall Street loves narratives. They love stories. People love to chase stories and narratives. We call them macro tourists. Whatever the headline of the day is, macro or otherwise, then that's what they chase. So they start chasing charts. And since they don't have a process or a discipline, that's what gets them in trouble and that's what gets them hurt. And so my job is to ignore narratives, focus on numbers, keep you away from things that'll get you hurt, and focus on the stuff that makes you money. And so that's exactly what we've been doing, and that's exactly what, God willing, we'll continue to do as we progress through 2021. Now, what have we seen? Well, you've heard me talk an awful lot about quads, right? The economic sine curve moves itself up and down and so on and so forth through economic cycles until we get a full business cycle and a full investment cycle. We focus on being full cycle investors and a full macro aware set of investors, meaning that we can have access to and invest in just about anything, presuming it's in the right quadrant at the right time that provides us the appropriate signal. So what I want to do real quick is just kind of break down for you quickly how I decide, what I decide, and when I decide it. Step number one, rule number one, test number one is always where are we on the economic sine curve, right? So the economic sine curve, as I said, is a function of a movement of a sideways S where it peaks and troughs and goes back and forth. It's not so much in terms of exactly where we are, although that is important. What's important is the calculus of it, which means the rate of change. Where are we going? Where were we? Where are we headed? What's that rate of change? What's the speed of that rate of change? Notice these are all numbers. These are not narratives. There's a calculation process that goes into figuring out what that process or what that movement is going to look like. And so in 2020, we moved ourselves in and out of very, very protective environments, which is what we would call quad 3 or quad 4. Quad 3, quad 4 is stagflation or deflation, both of which are very bad in most cases to many sets of risk-based assets. The things in a stagflationary environment that typically do well are things like gold and cash and oftentimes treasuries and investment-grade credit. Not too many on the risk cycle. Quad 4 is worse, right? Quad 4 is where deflation happens. It's the only place that the U.S. dollar actually goes up in. All other three quadrants, economically speaking, you'll typically find the dollar in a bearish trend, continuing to move itself up and down, but in a downward fashion. And so when that happens, of course, that brings on a whole new set of choices and decisions in terms of how to invest and what to invest in. So right now, basically since about mid to late November, we've been seeing ourselves develop stronger and stronger into quad 2, which is growth with inflation accelerating. Now, I know you'll turn on TV and I know you'll hear people talk and blather all sorts of stuff. You'll hear the Fed say that they're not seeing inflation. We all know that that's just garbage. You can see the inflation. We eat the inflation. Corn, just as an example, like corn on the cob, corn that you eat, is up 67% since June. Now, the last time I checked, that's pretty inflationary. Those of you who are in the development or building businesses know exactly what's happened to lumber. Lumber's gone through the roof, wood in general, wood products, oil, soybeans, wheat, cattle, hogs, copper, metals across the board. You name it, it doesn't matter what it is. If it's a commodity, it's finding itself ripping to the upside, and that's not likely to slow down anytime soon because in Quad 2, it's all about growth and it's all about accelerating inflation. So the positions that we take are first and foremost defined by where are we within the economic cycle. And as long as we can understand and see what the rate of change is on that economic cycle, the movement from one particular quadrant to another particular quadrant and getting that pivot correctly, but the movement and the speed of that movement. And so far, we really are still at the beginning stages of this Quad 2 type development and Quad 2 type movement. And so therefore, we anticipate probably until, it's hard to always get it exactly right, but at this point, based on the data feeds, based on the math, it suggests that we would see somewhere in late spring, maybe early summer, before we have to even consider a Quad 2 pivot away from growth to accelerating inflation. So that's step number one. In other words, if we identify and define exactly where we are in the economic sine curve, that identifies the players that we should put on the ice. So in other words, when you go through a process of identifying where we are in the economic sine curve, and you know that it's growth with inflation accelerating, you can also go through and do the math and identify, well, what has a tendency to perform the best within that economic quadrant. And historically speaking, it's technology, it's industrials, it's materials, it's transports, it's higher beta kinds of investments. Beta is nothing more than a fancy term for calculating and figuring out risk as it relates to some benchmark, for example, like the S&P 500. So if the S&P 500 has a beta of 1, pretty much anything that has a beta greater than 1 is something that will outperform and do better in Quad 2 than the market itself. So we want exposure to some high beta. Small caps, energy, financials. The reason financials do so well in Quad 2 is because interest rates are accelerating and they continue to rip to the upside. I'll show you a few charts in just a moment, but give you a quick example of why 2020 was so difficult in terms of the movements between the economic cycle is that we flipped from Quad 2 to Quad 4 to Quad 3 to Quad 4 to Quad 3 to 4 to 2. It's maddening. I don't know that I've ever seen anything like that before. And so when that happens, it creates an environment where the volatility regime of the market, i.e. VIX or VXN for the NASDAQ, remain in an uninvestable type stratosphere. And that is certainly something that we found throughout 2020. So quads 3 and 4 are all about protection. Quads 1 and 2 are all about going after growth and going after gains. And I would suspect that if you took a moment and looked at your portfolios between the beginning of the year or even mid-December until now, you'd notice a sizable difference simply because as the movement through Quad 2 continues to grow and develop, the types of investment assets that we have been putting on and been holding through this cycle so far are exactly the kinds of investments that we would have expected to do well. What's interesting about this particular Quad 2 development is that it's not just focused in the U.S., it's global. And when I say global, I mean global, from Poland all the way to Russia, to Saudi Arabia, to South Korea, to Taiwan, and pretty much every stop in between. What we're attempting to focus on are those particular economies on a global scale to help give us some diversification on an international basis, but not too much. But nevertheless, give us some diversification in the countries with economic cycles whose rate of change is moving the quickest through Quad 2 into potentially Quad 1. And so where is that? Well, that's places like Japan. That's places like South Korea. Taiwan, Germany, Poland, Russia, Saudi Arabia, the Netherlands, Switzerland, Sweden. These are some of our favorite long exposures to the international sphere. And we certainly, when the timing is right, will be able to continue to put those on. So I mentioned timing. That's the second element of how and when we decide what we want to do. Test number one, where are we on the economic sine curve? What quadrant are we in? And so this is a quick picture of what the quadrants look like. And you can see that we've flopped all over the place. If you would have looked at Q4 of 2020, it was way over in here for a period of time, and then it snapped back up in here. So it's a crazy process and a crazy movement, but it's all focused on three main things to identify where we are in the economic sine curve: growth, inflation, and policy. Growth is a function of the rate of change of GDP and what it looks like that's headed towards. Just understand that Q1 of 2021 will likely report the highest and largest rate of change of growth of GDP in the history of our country, and not just here, but globally. We're anticipating a 10.7% GDP print for Q1. Now that's ginormous. I'm not even sure that that's a word, but it's big. Inflation headline print, we're anticipating something with a 3 handle, like 3%. That is amazing and very, very big. Some would say, well, that's going to cause the Federal Reserve to eventually raise interest rates. Now, again, I'll get into the interest rate comments in just a few moments because I don't disagree with that, but that's not necessarily in and of itself a problem. If someone says the Fed's going to raise interest rates, again, I hear no math and I hear no mathematical conversation nor numbers in that. What I hear is a narrative. Narratives don't matter, numbers do. Numbers lead the narratives, not the other way around, although macro tourists will sit back and say, well, the narratives are what matter because that's how Wall Street works. No, that's not how it works. Again, test one, where are we on the economic sine curve by developing and identifying all the data points for GDP growth, inflation, GIP is the model, growth, inflation, and the last one's policy. Now, some might say policy is riddled with narratives. It can be. However, for us, policy is a function of and driven by what the Fed is doing with their balance sheet. Is it expanding or is it contracting? Clearly, when you look at the math of the Fed's balance sheet, it's expanding. And to just give you some context, again, these are all mathematical equations. These are all things that we look at and identify from a mathematical point of view. Right now, when you look at $8.1 trillion of expansion of the Federal Reserve's balance sheet and its rate of change towards that number, which is approximately $120 billion a month of bond buying, okay? That means that by June, we would anticipate somewhere between $8.1 to $8.2 trillion of a Fed balance sheet. When you calculate the math of that, what that means is it has a capacity for the equity market to expand at roughly 3% per month. Now notice what I didn't say. I didn't say that the market will grow or expand by 3% per month. What I said was it has the capacity to. And so therefore, if it has the capacity to do that, we want to make sure that we're focused on being long or owning appropriate core positions specific to Quad 2 growth with accelerating inflation, such as tech, materials, transports, energy, financials, commodities broadly, internationally, those countries that I mentioned. The second test, which is super important, is the timing of it. When calculating the timing of something, it's a function of doing, again, the calculus, the rate of change modeling, the mathematical motion between price, volume, and volatility, with volatility being the primary driver. So if volatility is the primary driver, what we want to know is when is volatility spiking, because that's our buy signal, and when is volatility leaking out of the market or getting really low. And that's when we want to be sellers of positions that we own, or at least create a little bit more protection in the portfolio. And so we have this mathematical modeling system. As you know, I get up every single day and do piles of math to the market and lots of notations that helps me to identify that calculus. And so what we're looking for when we do a calculus of price, volume, and volatility is its rate of change. We want to know, are we setting higher lows and higher highs within a bullish trend within those calculations? Or is something changing? Is there a lower high that is signaling the possibility of a stagnation? So in quad 2, it's all about who do we put on the ice? That's defined by knowing where we are within the economic cycle, i.e. quad 2. And then when do we put them on the ice is all about the market signal, which is a function of price, volume, and volatility. And so right now we're in the midst of what's called the chop. The chop just means that when VIX hits 20, we sell some stuff. When VIX hits 27, we buy some stuff. It's pretty much that simple. Now, obviously, we're looking at several different volatility measurements for the NASDAQ, the Russell 2000, essentially a volatility measurement for every single security that trades in the open market that might be something we want to buy. So I commented on interest rates. Let me show you a chart that might be helpful to recognize where we are in terms of the economic cycle, because everyone always wants confirmation. So confirmation in quad 2 comes from looking at a number of different things. You look at interest rates, you look at currencies, you look at equity movements. You want to see is the rate of change of those identifiers that I mentioned, again, tech, energy, financials, materials, transports, are all those things growing at a rate greater than what maybe value or something like that might be doing? And the answer to that real quickly on the equity side is yes. But look at interest rates. So this is a picture of the 10-year Treasury. On January the 1st, or 4th in this case, the first trading day of the year, the 10-year Treasury was actually trading right around 0.91%. Since that point in time to today, the interest rates are up to 1.1%, which is almost a 20% increase in that rate of interest, that percentage rate of interest. Last time I checked, that's a rising interest rate environment, and that's what you expect to see in quad 2. You expect to see interest rates go up. So the 10-year Treasury interest rate is going up, and we keep getting signals for higher highs and higher lows in the interest rate, which means for Treasuries, bad stuff. Owning Treasuries and investment-grade credit in quad 2 is very, very dangerous. It's problematic. And I talk on my radio show all the time why it's super important to understand where we are in the economic cycle and then how to identify the signals of what to buy and when to buy it and what to sell and when to sell it. And if you don't understand where we are in the economic cycle and you say to yourself, well, I want some protection in my portfolio, so I'm going to buy Treasuries and I'm going to buy investment-grade bonds, that's exactly the opposite of what you should be doing in quad 2. And let me again show you why. So here's a quick picture of the 10-year, 20-plus year long-term Treasury bond. And just since the first trading day of January to today, that bond's down 3.4%. Well, that's not going to give your portfolio really any protection. Investment-grade credit. Again, look at the volatility that we're experiencing out of investment-grade credit. So it's clear that there are some things that work and some things that don't work in quad 2. And when we're in a rising interest rate environment, Treasuries and investment-grade credit are not where you want to be. You would want to be in senior bank loans or levered loans. You'd want to be in business development company debt. You'd want to be in convertible bonds, preferred stock in many cases. We have exposure to all those. We also have exposure to inflation-protected securities with a yield curve steepener. What that means is that in quad 2, 2-year Treasuries and 10-year Treasuries are going to continue to widen. In other words, that curve gets steeper and steeper because the anticipation for greater economic growth is becoming more and more and more of a reality. So as the yield curve steepens, then a position in something like IVOL, which of course we currently own, continues to go up. And so you can see how this was kind of sideways movement throughout this cycle where the market wasn't sure we were going into quad 2, to all of a sudden quad 2 becoming a very big reality. And the growth of this obviously up roughly 3%. Since January 4th, the growth of this particular position, again, this is a fixed income position, is up about 0.7%. And so the question becomes, are you in the right fixed income assets for the appropriate economic cycle? We are. We own fixed income in a limited capacity and a limited degree that allows us to make money as interest rates are going up. and interest rates do not look as if they're going to want to come down anytime, at least in the near term. Now, going from 0.9% to 1.2% on the 10-year Treasury is rare, but that doesn't matter. What matters is the rate of change, and what matters is the market's anticipation and us doing our job as best as we can to front run that machine. So in terms of volatility, I'll just show you another quick picture with regards to the volatility segmentation. This is a picture of VIX, which is S&P 500 volatility. We would typically look, at least based on the current math of the day, between 20 and 27 is the range of motion that we would expect volatility to move. So when it gets real low, we want to expand some protective features. We want to maybe raise some cash. We want to invest in some things other than direct equities. Maybe pull down off of our max long exposure. The maximum long exposure to any one equity holding is 6%. Right now, we're running 5% or less in most cases for any one equity holding that we have. And we've diversified those assets, into some currencies. So I commented in Quad 2, there are some things that work on the downside. And one of those is the US dollar. This is an exchange-traded fund symbol, UUP, which is an expression of the US dollar and the dollar index symbol, DXY. And you can see since June, when we talked about inflation accelerating, the dollar is down a fairly considerable amount. An 8% move in a commodity is a lot. And it does not look like it wants to stop going down anytime soon, much of which because the Federal Reserve continues to print money, and yes, there are some narratives built in that, but the mathematical process and the rate of change of that printing, of that bond buying, of that expansion of the balance sheet continues to go up, and that puts a lot of pressure on the dollar. So we are short US dollars for those of you who have an account appropriate for that particular kind of risk. That just means that as the dollar goes down, that position that we own makes money. We also own Swiss francs. Swiss francs happen to be a currency that are in high demand for a number of reasons, but mathematically speaking, it has, again, the highest propensity for a rate of change from its low end of its mathematical cycle to its high end of its mathematical cycle. So we've recently purchased some Swiss francs as expressed by the exchange-traded fund FXF. We bought these down here. You can see today they're up about there. So we own these simply kind of as a parking place while we're waiting for the volatility measurements, VIX, VXN, RVX, for the NASDAQ and the Russell 2000 to ramp themselves back up into a buy scenario for those underlying assets. And so while we wait, the dollar keeps going down. We make money on the dollar short. That causes Swiss francs to go up. We make money on the Swiss francs. When that hits a particular level that I have already logged into the system, we sell out of those things, or a good portion of them, and we buy back those equities that might be on sale. Maybe we'll see small caps on sale. Maybe we'll see tech on sale. Maybe we'll get an opportunity to buy more energy or industrials or transports. And I'll just give you a quick picture of those. So this is a quick picture of tech, which again has done pretty well, but we might get an opportunity to add to our position today. Energy, which continues to be on a tear. Materials, again, doing quite well. Industrials, which again has done well. We bought a very large position here in industrials. In fact, we went max long there. And then each of these green days up here, we've sold a very small portion. Transports, as I mentioned, continue to do well. High beta is this one. Momentum is this one. And the NASDAQ 100 is this one. So we continue to look for opportunities to buy. We look for continued opportunities to position ourselves into those particular asset classes that will provide an expanding growth of the portfolio while paying attention to the signals of price volume volatility on when to reduce risk and when to increase risk to help us manage the edges of those core holdings. I know many of us have sat back and have been concerned and worried by some of the things that we've seen happening, not only out of out of Washington, but across the country with regards to censorship, with regards to potential attacks on free speech. And I know that a number of people have a lot of concerns. I understand. Those are all narratives. The market, and this is hard to understand and certainly for many very, very hard to believe, the market doesn't care. Nor does the market care what I think, nor does the market care what anyone thinks. The market's going to do what it wants to do, which is why it's super important to have a daily discipline, to have a daily mathematical process, and a daily program that helps us to identify what to do and just, if not more importantly, when to do it. And so that's exactly what we do. I'm going to ignore the narratives. If it doesn't have a mathematical equation attached to it or a conversation built around and with numbers, then to me that's kind of a conversation that's senseless and doesn't make sense as it relates to providing and protecting growth along with the protection of the portfolio. So that's it. I know today's video went much longer than normal, but I thought it was important to give you a good explanation and a good understanding and a good directive of why I do what I do and when I do it, and what it is that I follow to help me identify those particular pinpoints. So if you have any questions at all, please let me know. I understand that there's a lot of nervousness out there today. Many people are asking themselves, how in the world can the market keep doing what it's doing? How in the world can it grow? Well, to some extent, yeah, of course there's a bubble. And that bubble is going to get a lot bubblier, both on growth and inflation, because Wall Street's just not positioned correctly for it. We follow something called consensus CFTC futures and options positioning. That gives us an opportunity to get a glimpse into how Wall Street is set up. And Wall Street's net short on the S&P 500 and in some cases many other asset classes, which means they have to unwind those hedges as the market goes up, which creates more buying pressure on the market than selling pressure. Are we going to have some bouts here and there of some volatility? Of course. We did on January 4th, which we were taking advantage of by buying several of the positions that we had sold out of. So now it's just a process of that constant planting, pruning, growth, and trimming along the way. So again, if you have any questions at all, please let me know. I am super thankful to work for you, and I welcome any questions that you might have. You can either call me, 608-354-1977 is my direct line. Email chris@careformywealth.com. If you want to meet in person, that's great. If you want to do a Zoom call, that's great. If you want to chat on the phone or just go back and forth with email, whatever suits you. Whatever I can do to help answer any questions that might be on your mind. So with that, this is the end of series number 1. I hope I didn't exhaust you and bore you to tears, but I felt it was important to give you some good perspective on how I do what I do. Thanks so much. Have an amazing day.